we could get to an overshoot, whatever that is. Let's say $200 silver. Maybe it should be 2,000. I don't know. The market knows more than I do. But let's just say 200 for talking purposes. And let's say the equilibrium price is, I don't know, 100. So it could go to 200, trade there for a few days, a few hours, a few minutes. I don't know, but not for very long.
At some point in time, the generalist investor comes down into the precious metals market, having been attracted by gold's momentum. And then perhaps because of its unit cost, silver takes over the leadership. And when it does, as you know, it's truly dramatic.
Leading silver analyst David Morgan, publisher of the Morgan Report, draws parallels between today's market and the historic 1980 rally when silver hit $50, a 300% increase from the previous year. He believes a similar repricing could occur, speculating silver might overshoot to $200 even if its sustainable price settles closer to $100. Eric Sprott, another prominent precious metals analyst, shares Morgan's bullish conviction with even more specific targets. "I'm sure we're going to be through US $50, Sprott stated confidently. His analysis points to silver's historical trading ratio with gold, noting that it used to trade at 15 to 1 to the price of gold. At current gold prices, this ratio would translate to silver prices exceeding $200 per ounce. Sprott sees no fundamental reason why silver cannot reach these levels again. Similarly optimistic, analyst Oliver anticipates rapid price acceleration once silver breaks through current resistance levels. "I think the first surge could get you well above US $50. I think you'd get up in the US $60s and US $70 before you even pause, and I think it could occur rapidly," he predicted. This forecast suggests that once silver gains upward momentum, the price movement could be swift and substantial. Morgan remains focused on immediate technical as silver hovers around $40, recently pulling back to $39 from a 14-year high. He questions whether silver will spike directly to $50 or build a steady base, emphasizing that base building is crucial for sustainable gains. Before we begin, don't forget to like, share, and subscribe. Hit the subscribe button and turn on the notification bell so you never miss our latest market insights.
I want to be consistent, but like anyone else, more data, I have the right to change my opinion. But I just got a chart up here real quick, and I think it'll be next year still. Could be this year. No one knows. But you actually prefer to see it go up, I wouldn't say slowly, but steadily, because again, once you get a parabolic move, then you've got a problem. It's going to come right back down. It's like throwing a basket, throwing a ball in the air. It goes up and it hits equilibrium where it stalls out to static for just, a tenth of a second, and then it starts down. That's not the case if you built that stair-step structure all the way up. So I'm very anxious to see what it does in the 40s. Does it go from 40 to 45 to 50, or that goes to 40, 42, builds a base for 3 months, and then, drops back down to 40 and tests it, comes right back to 42, and then it moves up to 45 all of a sudden. I mean, wait a minute, I should have bought it at 42. I thought that was the top price, and then it builds a base there or whatever. So I don't know. I don't know the character of the market. What I do know is past history, what we're talking today, and we already agreed, building those bases is very important. And so I'm more favorable actually to that. I'd rather get there where it's sustainable. And I just got some members' questions, from my members, and 2 of them basically asked the same question, what's it going to look like? And I said, it's going to look like another spike. I mean, silver and many markets, but particularly silver, has a propensity to do these spike highs and spike lows. And I do believe that's what will happen. Going back to 1980, I just did an update or my weekly perspective on what happened in 1980. There was an intraday high at 50, but what I said was that it repriced for about 300% from what it had been the year before. And I think we'll see the same thing. So for talking purposes only, we could get to an overshoot, whatever that is. Let's say $200 silver. Maybe it should be 2,000. I don't know. The market knows more than I do. But let's just say 200 for talking purposes. And let's say the equilibrium price is, 100. So it could go to 200, trade there for a few days, a few hours, a few minutes. I don't know, but not for very long. Starts down. People start getting scared. Oh my gosh, I missed the top. I better sell. I'll take it. So you get some selling pressure, and it drops to, I just said 100, but 150 or some other number. And then it starts to go sideways. Well, now you've established, and for some time. So now you've established a new trading range that's far higher than the 40 that we're talking about now. let's say it does what it did in 1980, it does kind of a triple. So you'd be looking like 120. And, the miners are happy. The manufacturers aren't really that sad because it's price inelastic on the demand side because they use so little silver per unit. There's not many ounces of silver in a flat screen TV or in a cell phone, or, unless you're talking silver jewelry, silverware, the silver used in industry per product use is very small cost-wise compared to the overall product, like a refrigerator, washing machine, television, you name it. So, yeah, they might gripe and complain about it, but the truth of the matter is it's inelastic because it's essential. They can't do the product without it. And again, the overall cost of it being 120 an ounce may be great for a silver investor, but for a silver manufacturer, it doesn't really hurt them. In most cases, there's a few. The silver market, when I say the silver market, what I mean by that is what I just said. I mean 1,000-ounce bar commercial market. That's the granddaddy of everything. Yes, it's a derivatives market. Yes, it's heavily traded. Yes, there's been fines paid for spoofing. Yes, yes, yes. I'm pretty aware of all of that stuff. However, when you are in the retail market, you are talking, you're not talking 1,000-ounce bars. You're talking retail product, which could be silver coins, silver rounds, 1-ounce wafers, 10-ounce bars, kilo bars, 100-ounce bars, junk silver or constitutional silver. All those products are on the retail side. And that's a big market, but it's not the total market. And so if someone says the silver market is very, very tight, and they're referring to the retail market only, they usually don't specify. So people get the idea that the entire silver market is extremely tight. And because of that fact, they're going to have to pay up to buy silver. Well, the retail market could be extremely tight. And because of that fact, they have to put on a larger premium to get it because, price is supposedly the arbitrator between supply and demand. If the supply is very scarce and demand is very high, then the premium will move up. But it gives, in my opinion, strong opinion, this is a bit misleading because let's say you did what I did back in the 2008 crisis and silver got smashed down to below 9. But yet retail had kept the price up, I'm going to say around 10, maybe it was 9.5. I don't know. That the retail market is very tight. The retail market is flush with silver and the commercial market is very, very tight. And of course, it's the commercial market that drives the price because the price is a derivatives contract. It's a contract for 5,000 ounces of 999 fine silver. Of course, there's the mini, which is the 1,000 ounces. And that market just is getting tighter and tighter. And as the tweet talked about, there was really no shares available to short the SLV, which is very, very, raises your eyebrows. So a lot going on that side. And yet, if you talk to the wholesalers, it's like their premiums are very, very, very low because they have so much inventory. They don't want to have to pay, the carrying cost to hold it. So again, the silver market itself is the commercial market, very, very, seems to be very tight. But the retail side, not so much.
Veteran investor Rick Rule, having witnessed 3 major precious metals bull markets, believes a 4th cycle is beginning. His experience shows a consistent pattern. Gold leads by attracting general investors, but silver often outperforms due to its lower cost and broader accessibility. Historical data since 2000 confirms an inverse relationship between gold prices and the gold-to-silver ratio. When gold rises, silver typically rises faster, causing the ratio to decline and providing leveraged exposure to precious metals trends. Current forecasts support this outlook. Citigroup projects a 13% rise in silver for 2025 driven by tight supply and strong investment demand, while forecasting a 25% decline in gold by 2026. The shifting gold-silver ratio adds momentum for silver's potential surge. Rule's confidence stems from the late 1980s, early 1990s rally when he backed silver standard from 72 cents to $45 and Pan American silver from 50 cents to $45. He expects the coming bull market to mirror past cycles, with silver outperforming gold and silver stocks leading gains. Silver benefits from strong industrial demand in electronics, solar panels, and medical applications, consistent support that gold lacks. Combined with supply constraints, these fundamentals could amplify price movements when investment demand increases. While gold offers long-term stability, silver presents compelling medium-term growth prospects. The combination of industrial demand, supply constraints, and favorable conditions positions silver to potentially outshine gold in coming cycles. Let's get back to the video.
I participated in 3 precious metals bull markets in my life. This will be the 4th. And at some point in time, and I'm never smart enough to say why, you probably are actually, given your competence in technical analysis as an example. At some point in time, the generalist investor comes down into the precious metals market, having been attracted by gold's momentum. And then perhaps because of its unit cost, silver takes over the leadership. And when it does, as you know, it's truly, truly, truly dramatic. And although I don't need to make more money, I want to make more money. I really, truly enjoy the game. I'm 72 years old, and I want to experience that sort of quantum escalation at least one more time in my career, and silver gives it to me. When I came into business, I'm older than you, as you know, when I came into business in the 1970s, I witnessed an amazing silver market. The stuff went from $1.30 in 1970 to $50 in 1981. One stock that I was aware of, but I was too dumb and too poor to buy it, was Coeur d'Alene. It went from 10 cents, this is not a typo, 10 cents in 1970 to $65 in 1981. And that stuck, you know, that stuck in a young man's mind. But I didn't participate. But as I think you know, in the later part of the 80s, the early part of the 90s, which was a spectacular silver market that people forget, I was involved in Silver Standard, which we took from 72-cent financing with a full warrant, thank you, to 6 years later, $45. And Pan American Silver from 50 cents, Ross Beatty was too cheap to give me a warrant, to $45. Those two moves, from below $1 to $45 in 6 years, stuck with me and have stuck with me forever. We are, I believe, coming into a precious metals bull market that will resemble the best of the prior markets. And if past is prologue, that same performance, I'm not saying $1.30 to $50, don't get me wrong, but that same sort of relative outperformance, silver to gold, and then silver stocks to silver, I think we'll see in this market, and I'd like to play it. I remember 2 years ago at this conference being asked by one of the people in the audience when gold was finally going to move. And you know, Trey, I scratched my chin sagely, and I said, I think gold's going to move in the year 2000. It's up 9% compounded for 25 years. People's expectations, I think, were inflated as a consequence of the decade of the 70s, and the fact that an asset class was up 9% compounded didn't register to people as a move. 50%, now people are getting interested, and the consequence of that is that they have the courage to make other projections, which I believe they harbored all along. My belief is that gold does well when people are concerned about the maintenance of their purchasing power in US dollars. I've been concerned about that for a very long time. The arithmetic that concerns me is not expressed by the CPI, which I don't think is a good index, so I've been surprised by the muted response of gold hitherto. I didn't know, as you know, because we talked about it, when gold was going to move. But it seemed to me like an inevitability. As you and I both have talked about, I have a flaw in that I often confuse the words imminent with inevitable. But no, I haven't been surprised at all. When I talk about the deterioration in the purchasing power of the gold, I'm talking about in an absolute sense, not in a relative sense. I think relative to other currencies, gold will do well. Franz Pick said there's a lot of ruin left in a country this great. Ruefully, I agree with that. I believe that gold will be the world's reserve currency for the balance of my life. For the record, I'm a healthy 72-year-old. But I think its hegemony will reduce. When I look at
the dollar's hegemony.
Yes, it'll be reduced. I think the U.S. government is doing their best to destroy the U.S. Treasury as a savings instrument, politicizing it, debasing it. But what are the alternatives? Our friend, Doug Casey, once said the dollar is an I owe you nothing, but the euro is a who owes you nothing. And I mean, the other analogy is the prettiest mare at the slaughterhouse. I'm not concerned about the dollar relative to other mediums of exchange. I'm worried about the dollar as a storehouse of my own wealth. I personally, Trey, I'm telling this to your audience, you know this, I personally save in gold. I personally maintain liquidity in dollars. Those are two different statements. I believe that the analog to the deterioration of the purchasing power of the U.S. dollar that we're going to experience is the 1970s. In the 1970s, according to the Office of Management and Budget, the U.S. dollar lost 75% of its purchasing power. This is not some old fat libertarian, Rick Rule, saying this. This is the office, the Congressional Budget Office. I believe that because of the accumulated debt and deficit, particularly off-balance sheet debt, entitlements, and the unfunded entitlement liabilities, that the purchasing power of the U.S. dollar over the next 10 years is going to decline by 75% again. I don't know how it'll be reflected in the gold price, but the easiest thing for me to say arithmetically is that the increase in the gold price will mirror the deterioration of the purchasing power of the U.S. dollar. If that is more or less right, then the gold price goes up fourfold from here. People say to me, Rick, like, give your head a shake. Gold has already gone. It's already up 40%. If the analog is the decade of the 70s, let's assume that the move in gold price from $35 to $100 was a dead cat bounce off the restriction of the gold price. And let's say that the move in the gold price above 550 to 850 was morons piling on. That move from 100 to 600, six-fold move, is a pretty good move. And if the cause of it is the perception of the deterioration in the purchasing power of the U.S. dollar, I think it's absolutely right to assume that the increase in the gold price, the increase in the nominal gold price, could reflect the deterioration in the purchasing power of the U.S. dollar.